Understanding Forex analysis. Do you ever thought why all countries don't use the same currency? Why waste our time calculating conversions of one currency to another? The answer to all these questions is that most countries like making monetary decisions based on their interests and needs. That's why currencies are bought and sold, just like other goods are, and Forex is a digital marketplace for exchanging national currencies. Hello everyone, welcome to our channel. In this video we will learn how Forex analysis is done. So let's move right to the topic. Foreign exchange or Forex is the largest financial market in the world, with a daily volume of $7.5 trillion in April 2022. In Forex, we analyze the market and make decisions for trading. Two primary methods used for Forex trading are fundamental analysis and technical analysis. Each type of analysis has its own strengths and weaknesses, so understanding which type of analysis to use when trading Forex is important. We will learn about fundamental analysis. It entails looking at the broader economic, political and social factors influencing the currency of a country. We focus more on the intrinsic value of investment. It is used for long-term investing. Some of the factors that affect fundamental analysis are: we start with geopolitical events. The ongoing events such as elections, wars between countries or agreements in trade have an impact on a country's currency and Forex markets. Then, coming to economic indicators, GDP, inflation rates, debt and purchasing power, parity, etc. affects the country's economy, as per the report of International Monetary Fund's IMF. If you want to maintain the same standard of living in the US as in India, then you need to pay more for the same services. For example, if you take a cab in US and that in India, then you pay 20 times more in US as compared to India. Next, we will cover central banks. These are one of the most volatile sources for fundamental trading. They can raise interest rates or lower them, or keep it the same. When interest rates are high, it tends to attract foreign capital, strengthening its currency. Now we come to the technical analysis in Forex. Technical analysis is the study of the currency's behavior. It is used for short-term investing and focuses on price and volume. It is about examining price data and charts to identify patterns and determine probabilities of future price movements. It is not so much about prediction, it is about possibilities. Technical analysis involves the following. First, we will look at the price charts. These display the currency price movements over time. Traders study this chart to take decisions. Then we move on to the patterns in charts, like head and shoulders, flags or triangles. These patterns indicate potential future price movements. Finally, we look for the indicators. Technical indicators such as Relative Strength Index, RSI, Money Flow Index, MFI, moving averages, momentum readings, etc. give us details of the current price trends. Conclusion. In the world of Forex trading, both fundamental and technical analysis play vital roles. Experienced traders often use a mix of both. This approach helps to understand the bigger economic picture with the ability to spot short-term trends. Remember, no single approach works every time. By uniting the strengths of both fundamental and technical analysis, we can make intelligent decisions in the changing world of Forex trading. Thanks for watching.